It's really, you know what the craziest part of it is to me, Dunnigan, is that if you would have told me that, gold was at 3,000 bucks, let me look at the futures here real quick. And silver over 34. Let me just see what the futures are here real quick. Of course, my computer never cooperates when I'm asking it to. So the futures on silver are up to 34.63, and the futures on gold are at 3,039. If you would have told me that that'd be the case and there's virtually no mainstream media attention, I would have said there's just no way that that can be the case. I mean, my entire career, gold at 3,000, people would have said you're crazy. I remember when Jim Sinclair said gold would hit 1650, and he was called, he was looked at as being, crazy. There's no way gold could be 1650. This is when it was 400 and 500. So to see it at over 3,000, to close it over 3,000, to breach that level, and really not to see any acknowledgement of it is really shocking, especially with what's going on in London and New York. In London right now, there's 200 and roughly last week, I don't know, it's probably a little less now, but 279 million ounces of gold in London. Only 36 of that is available for delivery. The rest belongs to ETFs in the Bank of England. And that's standing behind 380 million ounces in outstanding spot contracts, 11 times nearly the number of contracts issued versus the amount of gold issued. And in silver, it's very similar. Roughly 270 million ounces of silver is all that's available of the 800 million. Now it's under 800 million, like 770, 780, because we saw 85 to 90 million ounces. That's what COMEX is on track for to be delivered for March of silver come into COMEX, almost all of it coming from the LBMA. And so all of, and when you talk about 290 million ounces and there's available, yet they're trading 2.9 billion ounces of silver, again, a 10 times the number of contracts standing behind or the metal standing behind those contracts, 10 times the number of contracts. To me, what it really speaks of is the lack of trust in the LBMA system, that no one trusts that they'll be able to deliver anymore. And they're trying to tell us that it's a logistics thing. It's a lack of trucks and a lack of manpower. I think they're realizing that the exchanges are being bled dry. And maybe now what we see is COMEX trying to distance themselves from the LBMA. In the last 3 months, 128.5 million ounces of silver have been withdrawn from London. And so you're talking almost 50% of the float gone in the last 3 months in silver. So between the amount of silver and gold delivered, not to mention all of the others that are standing for delivery, but they're being told it's 8 weeks. It seems like they're turning up the heat. And maybe, just maybe, that rumor of Trump trying to stick it to the Bank of England is really true, after all, because this is a very provocative move. And I think, it really does speak of the LBMA losing confidence globally in its ability to deliver. And this is the beginning. So I guess we'll see what the real reason is. Much like most of the things we've seen lately on the LBMA and COMEX, we can assume and surmise what the real agenda is. Mainstream would tell you that's not the case. I don't believe it. I actually feel that we are witnessing a shift from this paper market that all of us thought would never be broken into other hubs like Shanghai, like Moscow, like Dubai. These are cash and carry exchanges where the price setting is far more realistic, instead of a futures market where it's 90% paper and 10% physical, and no one ever stood for delivery. And you and I have been talking about this, and the logarithmic decay, little by little by little by little, and then bang. Are we at that point? Well, it sure feels that way when almost half of the available silver has been drained. And now they're saying it's logistics. We can't really get it over to you as fast as we would like. Demand for physical gold and silver is rising. And this is a move away from the Western markets. It's a big deal. We'll see how big it is. But yeah, I think this is something people really need to pay attention to, on top of the fact that it just continues to move higher. It seems almost every day now.
As we delve deeper into the intricacies of the precious metals market, it's evident that we're witnessing a significant transformation. The traditional paper-based systems, long dominated by institutions like the LBMA and COMEX, are facing unprecedented challenges. The ratio of paper claims to physical gold and silver has reached alarming levels, with some estimates suggesting a leverage of over 10 to 1. This means that for every ounce of physical metal, there are more than 10 claims, a situation that's unsustainable in the long run. The recent surge in physical deliveries, especially from the London Bullion Market Association to the COMEX, underscores the growing demand for tangible assets. In the past 3 months alone, over 128.5 million ounces of silver have been withdrawn from London vaults. This massive outflow indicates a shift in investor preference from paper contracts to physical holdings, driven by concerns over the credibility of paper markets and the increasing geopolitical uncertainties. Central banks worldwide are also adjusting their strategies. The People's Bank of China, for instance, has added approximately 600 tons of gold to its reserves in 2024 alone. This aggressive accumulation reflects a broader trend among nations to diversify away from the US dollar and bolster their reserves with tangible assets. Such moves are not merely about portfolio diversification. They're strategic decisions aimed at enhancing economic sovereignty and resilience. The reclassification of gold as a Tier 1 asset under Basel III regulations further emphasizes its significance in the global financial system. This change means that gold is now considered a risk-free asset on par with cash and government bonds. Consequently, banks are incentivized to hold more gold, reinforcing its role as a cornerstone of financial stability. Moreover, the emergence of alternative trading hubs like Shanghai, Moscow, and Dubai is reshaping the global precious metals landscape. These markets prioritize physical transactions over paper contracts, offering greater transparency and reducing the risks associated with leverage. The Shanghai Gold Exchange, for example, operates on a fully allocated basis, ensuring that every contract is backed by physical metal. This model contrasts sharply with the practices of Western exchanges and is gaining traction among investors seeking security and authenticity. The current economic environment, characterized by inflationary pressures and currency devaluations, further amplifies the appeal of gold and silver. As fiat currencies lose purchasing power, tangible assets like precious metals offer a hedge against inflation and a store of value. Investors are increasingly recognizing this, leading to a surge in demand for physical gold and silver. And yet the public, your average investor, has been completely asleep at the wheel. They've been selling metals on the way up, selling gold, selling silver, buying Bitcoin, chasing meme stocks. And all the while, the most well-capitalized, well-informed entities on the planet are scrambling to get their hands on physical metal. That's not a coincidence. That's a divergence. And when that gap closes, when retail wakes up and starts competing with the central banks for the remaining physical float, you're going to see an explosive repricing like we've never witnessed before. I'm not talking about $3,000 gold. I'm talking about $5,000, $10,000. I'm talking about silver blowing through its previous highs and setting new all-time records, not because of some Reddit pump or ETF play, but because the system simply can't deliver anymore. Think of it this way. Every ounce of gold or silver you hold outside the system is one less ounce they can rehypothecate. It's one less ounce they can sell 10 times over. That's why physical ownership matters now more than ever. Not ETFs, not futures, not gold exposure. Physical metal in your possession or under your direct control. And if the current trend continues, if India, China, Russia, Turkey, and now even the US Treasury continue draining global exchanges, then the clock is ticking on the availability of that metal. We are, in my opinion, in the early innings of a monetary reset. Whether it's driven by geopolitics, de-dollarization, systemic banking risk, or a new blockchain-based currency regime pegged to commodities, maybe gold, maybe something else, what's clear is that the world is moving away from paper promises and toward tangible value. Gold is front and center in that transformation, and silver, with its dual role as both a monetary and industrial asset, is arguably even more undervalued and strategically important.
The United States is now prioritizing delivery over paper, which is something wholly, completely different. Almost all the gold that has come over the 25 million ounces or so, almost all of it has already been delivered. So if this delivery continues, you'll see strains on COMEX as well. All I can tell you is that whatever is happening in London, it's the beginning of the possibility of an existential event for some of these banks that are massively short if they get, copious amounts of delivery requests, 10 times the amount, 11 times the amount of paper versus gold, that's a situation I certainly wouldn't want to be involved in if I was a board member of one of these commercial banks.
So I'm still trying to get my arms around this COMEX delisting LBMA futures. The COMEX previously had allowed people to take future positions at London in New York. Is that the idea?
That's exactly correct. That's
so it sounds like
exactly right.
a vote of no confidence from the COMEX about the LBMA?
Absolutely.
While the LBMA has been saying
that's
nothing.
exactly what it sounds like to me.
Okay,
that they don't believe that they will be able to deliver what they said they would. And that's not a good thing. So yeah, and a lot of the banks who would hedge their positions would do so with unallocated contracts in London. So, you know, you take these massive short positions and then try to hedge it with unallocated positions in London. That's not a good thing. It's going to, in my mind, start to really emphasize physical markets versus futures markets. And that's something that none of us thought would have ever happened. Now, you know, I guess we'll find out. But it's not just the United States. I mean, we've seen in India in January and February, 44 million ounces of silver delivered to India on top of all the silver they've been buying over the last 4 years. So, you know, we're seeing China buy massive amounts of gold as well. And that's been well documented. China has purchased, what have they purchased? Let's see, I think I have that number. Central banks have purchased almost 1,200 tons in 2024 alone. So I don't have the exact numbers that China has purchased, but it's an awful lot. And look, the bottom line is that physical demand, de-dollarization, alternative exchanges, these things are all happening in real time and all at the expense of the LBMA. And it appears as though, I mean, if you take a step back and you look at it, you know, they throw out the idea of tariffs, which really don't seem what it is to me, and which allowed for all of these exchanges for physical with fungible COMEX contracts into London, and the metal was flowing. And then I think they're starting to realize that this is deeper. So then they come out and say, well, it's not a T+1 anymore, it's T+8 weeks. This is a big deal. And it's a big deal because the banks that have been suppressing the price forever.
You know, the craziest part of all this, and I mean truly mind-blowing if you followed the precious metals market for any length of time, is the sheer disconnect we're seeing right now between what's happening in the gold and silver markets and the absolute silence from the mainstream media. I mean, just stop and think about this for a second. Gold has decisively broken above $3,000 per ounce. Not a spike, not a flash in the pan, but a confirmed weekly close above $3,000. And silver is hovering north of $34. And yet, where's the coverage? Where are the CNBC panels, the Bloomberg roundtables, the New York Times front page stories? Nowhere. Crickets. That, my friends, tells you everything you need to know about where we are in the cycle. The price of gold is screaming monetary reset, while the media is still babbling about tech stocks and Bitcoin ETFs. If you told me even 2 or 3 years ago that gold would be trading at $3,000 and silver pushing toward $35, and that this would barely register a blip in financial headlines, I would have said no way, not a chance. I remember when Jim Sinclair made his bold call that gold would reach $1,650 back when it was $400 an ounce. They laughed at him, called him crazy. Now here we are at nearly double that number, and the financial world is snoozing. Meanwhile, what's happening behind the scenes in London and New York is nothing short of a quiet panic. Let's talk about London first. The LBMA, the so-called epicenter of the global precious metals trade. According to the latest data, the LBMA is sitting on roughly 279 million ounces of gold. Sounds like a lot, right? Until you dig deeper and find that only 36 million ounces of that are actually available for delivery. The rest is spoken for, locked up by ETFs, central banks, and sovereign entities like the Bank of England. But here's the kicker. Those 36 million ounces are standing against more than 380 million ounces in outstanding spot contracts. That's a leverage ratio of nearly 11 to 1. Let that sink in. There are 11 claims for every actual ounce of gold available for delivery in London. That's not just over-leveraged. It's a systemic risk hiding in plain sight. And silver? It's arguably even more strained. There are just under 800 million ounces registered in the LBMA vaults. But again, only a fraction, maybe 270 million ounces, is available for actual delivery. Yet they're trading almost 2.9 billion ounces of silver per day on paper. That's more than 3 times the entire annual global mine supply. It's paper alchemy, pure and simple. And the real shocker? COMEX has been importing massive quantities of physical metal to backstop these trades. 85 to 90 million ounces of silver for March alone, most of it coming straight out of the LBMA. That's right, we're seeing the Western gold and silver exchanges literally drain themselves dry to meet delivery demands. And here's where it gets really wild. In just the last 3 months, 128.5 million ounces of silver have been withdrawn from the London vaults. That's nearly 50% of the available float. Gone, moved, delivered. And now the LBMA is trying to explain away their delivery delays by blaming logistics. They're saying, well, it's just a manpower issue, a truck issue. Really? You've been delivering metal flawlessly for decades, and now all of a sudden you can't find a guy with a truck to move bars across town? What this really is a loss of confidence. It's the beginning of a physical run on the LBMA system, and the banks know it. That's why COMEX is starting to distance itself from the LBMA. That's why the COMEX recently delisted LBMA futures as a deliverable category. They're pulling the plug on that pipeline before it blows. And where is the demand coming from? It's not mom-and-pop investors. It's not your average retail buyer stacking coins in their basement. This is sovereign-grade buying. The People's Bank of China has added at least 600 tons of gold to its reserves this year alone. Probably more, since not all central bank purchases are disclosed in real time. India has been taking delivery of record-breaking amounts of silver, over 44 million ounces in January and February. And they're not buying futures. They're not buying options. They're standing for physical delivery and removing the metal from the global float. That's the difference. This is not speculation. This is preparation. Meanwhile, here in the United States, something incredible is happening. The U.S. has quietly flipped from being a net exporter of gold to a net importer. Just since November, more than 25 million ounces of gold have been brought into the country, much of it from London, and almost all of it already delivered and settled. Why? What's going on here? Are we preparing for a revaluation? A new gold-backed instrument? A Bretton Woods III-style reset that pegs future treasuries to gold? I don't know exactly, but I do know this. You don't reshuffle the world's most important monetary metal in complete silence unless something major is coming. Now, I've said for years that gold and silver prices were being suppressed by unbacked paper derivatives, largely through a cozy relationship between the LBMA and COMEX. But that game is cracking. The sheer leverage in the system is no longer sustainable. And the players who have been suppressing the price, commercial banks like HSBC, JP Morgan, Scotia, they've lost the ability to offset their massive short positions with unallocated hedge books in London. When the COMEX or LBMA takes on massive naked short positions, their fallback plan has always been to hedge in unallocated form in the LBMA, which essentially means we owe you metal someday. Well, someday is here. Now people want the metal. And guess what? There isn't enough. Even more telling is the behavior of central banks themselves. They're insiders in the fiat monetary system, right? If there were ever a group that knows how the game works behind the curtain, it's them. So what are they doing? They're dumping treasuries in dollars and buying gold at record pace. According to the World Gold Council, 2024 is already shaping up to be another record year for central bank gold purchases. Why? Because they know what's coming. They're preparing for a world where gold once again plays a foundational role in monetary policy. You want to talk about insider buying? That's your signal right there. And yet the public, your average investor, has been completely asleep at the wheel. They've been selling metals on the way up, selling gold, selling silver, buying Bitcoin, chasing meme stocks. And all the while, the most well-capitalized, well-informed entities on the planet are scrambling to get their hands on physical metal. That's not a coincidence. That's a divergence. And when that gap closes, when retail wakes up and starts competing with the central banks for the remaining physical float, you're going to see an explosive repricing like we've never witnessed before. I'm not talking about $3,000 gold. I'm talking about $5,000, $10,000. I'm talking about silver blowing through its previous highs and setting new all-time records, not because of some Reddit pump or ETF play, but because the system simply can't deliver anymore. Think of it this way. Every ounce of gold or silver you hold outside the system is one less ounce they can rehypothecate. It's one less ounce they can sell 10 times over. That's why physical ownership matters now more than ever. Not ETFs, not futures, not gold exposure. Physical metal in your possession or under your direct control. And if the current trend continues, if India, China, Russia, Turkey, and now even the US Treasury continue draining global exchanges, then the clock is ticking on the availability of that metal. We are, in my opinion, in the early innings of a monetary reset. Whether it's driven by geopolitics, de-dollarization, systemic banking risk, or a new blockchain-based currency regime pegged to commodities, maybe gold, maybe something else, what's clear is that the world is moving away from paper promises and toward tangible value. Gold is front and center in that transformation, and silver, with its dual role as both a monetary and industrial asset, is arguably even more undervalued and strategically important. So if you're still waiting on the sidelines, hoping for a pullback, ask yourself this: is that really a bet you want to make when the most powerful players in the world are clearing the shelves? When COMEX itself is waving red flags and shifting delivery protocols, when 10-to-1 leverage ratios are standing against real metal and the system is fraying under the weight of physical demand? Because at the end of the day, this isn't just about price, it's about trust. And once that's gone, once the world loses trust in the promise of future delivery, we move from a paper world into a physical one. And in that world, the winners are those who saw it coming and acted early.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.